Welcome to today's initiation of coverage on Taiwan Semiconductor Manufacturing Company, ticker TSM. In this presentation, we unpack the fundamental architecture of the global AI supply chain, where TSMC sits as the absolute choke point. While the market heavily weights fabless designers like NVIDIA and AMD, our thesis posits that the terminal value of the AI hardware supercycle is fundamentally constrained by TSMC's advanced node capacity. Currently capturing over 90% of the market share in sub-7 nanometer fabrication, TSMC represents a monopolistic toll booth on generative AI. We will review our proprietary revenue compound annual growth rate models, operating margin expansion forecasts, and a sum of the parts valuation to justify our overweight rating. We project an upside heavily driven by high-performance computing, effectively decoupling TSMC from legacy consumer electronics cyclicality. Examining the macro market dynamics, the total addressable market for AI accelerators is experiencing an unprecedented structural expansion. Our channel checks and supply chain analyses indicate high-performance computing, or HPC, will command a compound annual growth rate of 45% through 2027. Unlike previous semiconductor cycles driven by smartphone penetration, the current capital expenditure cycle is fueled by hyperscaler infrastructure spending. TSMC is uniquely positioned here. We model the silicon content per AI server to be roughly 10 times that of a traditional x86 server. Furthermore, the bottleneck isn't just silicon fabrication, it is advanced packaging. CoWoS, or chip-on-wafer-on-substrate, capacity limits are defining the upper boundary of AI chip shipments globally. TSMC's aggressive capacity expansion in this specific vertical forms the bedrock of our upwardly revised forward earnings estimates. Assessing the competitive moat, TSMC's technological lead over peers, Intel and Samsung Foundry, is currently unassailable in the near to medium term. The transition to the 3-nanometer and upcoming 2-nanometer nodes, utilizing gate-all-around transistor architecture, requires prohibitive capital intensity. TSMC's execution on yield curves gives them unprecedented pricing power. We estimate their N3 wafer pricing commands a 25% premium over N5, reflecting inelastic demand from fabless designers who require leading-edge performance per watt. Furthermore, TSMC's tightly integrated ecosystem, encompassing IP libraries, electronic design automation partnerships, and packaging, creates a sticky ecosystem that effectively locks in top-tier clients. The switching costs for a Tier 1 designer to migrate to an alternative foundry are prohibitive, both in absolute capital expenditures and time-to-market risk. Shifting to our quantitative top-line projections, we model a robust acceleration in revenue and EPS. For FY24 through FY27 estimated, we project a consolidated revenue CAGR of 18.5%, significantly outperforming the broader semiconductor industry average. This is propelled by a favorable mix shift towards sub-5 nanometer wafers, which we expect to constitute over 65% of total wafer revenue by year-end 2025. On the bottom line, EPS growth is projected to outpace revenue, modeled at a 22% CAGR over the same period, driven by operating leverage and easing depreciation headwinds on fully ramped N5 nodes. While gross margins may see transient dilution during the initial N3 ramp phase, the blended average selling price accretion will aggressively pull up the terminal EPS, supporting a higher normalized earnings base. Analyzing the capital allocation framework, TSMC operates in an extremely capital-intensive environment, yet maintains a highly disciplined CapEx to revenue ratio constraint, typically pegged around 30 to 35% in steady-state operations. For FY24, management has guided CapEx between $28 and $32 billion. The critical focal point for institutional investors is the free cash flow yield. Despite this massive capital outlay required to build out fabs in Arizona, Japan, and Germany, our discounted cash flow model projects a robust structural free cash flow expansion beginning in late 2025. As the initial heavy lifting of the N3 build-out concludes, capital expenditure intensity will normalize. We project a forward free cash flow yield of approximately 4.2% by FY26, providing ample liquidity for an ascending dividend distribution policy while funding ongoing R&D outlays. Turning to the margin profile, TSMC's ability to defend its gross margins is a testament to its pricing power and structural dominance. Historically, the company targets a long-term gross margin of 53% or higher. While overseas expansion and inflation in raw material costs present near-term margin compression risks, our models indicate that value-based pricing on N3 and N2 wafers will comfortably offset these headwinds. Operating margins remain best in class, modeled to stabilize around 41%. SG&A remains relatively fixed as a percentage of revenue, highlighting the massive operating leverage inherent in the foundry model once a node achieves mature yield rates. The key metric to watch is the utilization rate of the 5nm and 3nm fabs. Our base case assumes an aggregate utilization rate holding firmly above 85% through the forecast period. On valuation, TSMC represents a severe dislocation between fundamental earnings power and market multiple. Trading at roughly 18 times forward earnings, the stock is valued at a steep discount to the Philadelphia Semiconductor Index, which hovers near a 26 times forward PE multiple. On an enterprise value to EBITDA basis, the company trades at under 10 times our FY25 estimates. We argue this historical foundry discount is fundamentally mispriced, given TSMC's transformation into an AI infrastructure monopoly. The market is currently pricing in legacy cyclicality from smartphone and PC end markets, while ignoring the high-visibility, multi-year backlog in the high-performance computing segment. Re-rating the stock to a conservative 22 times forward PE, which is justified by its 22. A rigorous analysis must appropriately weight the downside risks. Our bear case is defined primarily by geopolitical risk premiums and potential cyclical macroeconomic headwinds. The concentration of leading-edge fabs in Taiwan introduces a non-zero probability tail risk of supply chain disruption. Consequently, the market inherently applies a geopolitical discount to the equity. Operationally, a macro-driven recession could dampen the recovery in PC and smartphone end markets, which still account for roughly 40% of total revenue. Furthermore, Intel's aggressive roadmap to regain process leadership via its 5 nodes in 4-year strategy, combined with massive U.S. CHIPS Act subsidies, could theoretically introduce pricing pressure at the leading edge by 2026. In this bear scenario, we model margin compression and a multiple contraction down to 14 times forward earnings. Conversely, our bull case scenario models an aggressive acceleration in global AI adoption. If sovereign AI initiatives and enterprise inference workloads scale faster than anticipated, demand for CoWoS packaging and N3 wafers will grossly exceed supply into 2027. Under these conditions, TSMC would exercise unprecedented pricing power, potentially revising wafer prices upward by 10 to 15% annually. In this scenario, operating leverage pushes gross margins sustainably above 56%. Additionally, if the overseas fab diversifications in Arizona and Japan ramp up with better-than-expected yield curves, the geopolitical discount could structurally narrow. Our bull case assumes a 25 times forward PE multiple on upwardly revised EPS estimates, projecting a near doubling of the market capitalization over a 24-month horizon. In conclusion, the foundational thesis is clear. You cannot be structurally long artificial intelligence without being long TSMC. The company is the indispensable physical layer of the global AI infrastructure. Factoring in our base case discounted cash flow valuation and a blended multiple approach, we are initiating coverage with a 12-month price target, reflecting a 35% upside from current levels. The risk-reward asymmetry is highly compelling for institutional portfolios. The short-term volatility related to geopolitical headlines provides tactical entry points for accumulating a core position. We expect the upcoming quarterly earnings call to validate our thesis on CoWoS capacity expansion and N3 margin accretion. Thank you for attending this briefing. We will now open the floor to questions regarding our modeling assumptions.